I'm looking at a commercial property right now. The asking price is $1.4 million. The seller is claiming it generates $120,000 a year in income. And if you just did the math in your head, you might think, that's not bad. But in about 10 minutes, I'm going to show you exactly how to figure out if a deal like this actually makes sense, or if those numbers are hiding something that will cost you everything. This is how I analyze every single commercial real estate deal before I ever make an offer. And by the end of this video, you'll be able to do the same thing. Hey, I'm Dan Parisi Avatar. Dan likes finding great real estate deals and working with clients. He is not so great in front of a camera, so I am doing that work for him. We focus on commercial and industrial properties. And I've been buying, leasing, and managing commercial real estate for years. On this channel, I pull back the curtain on how the deals actually work. No fluff, just the real math. If you're new here, hit subscribe because we're going to keep going deeper on topics like this. Now let's get into it. I'm going to walk you through the 5 numbers every commercial deal analysis starts with. Miss any one of them, and you can get burned badly. The first number is NOI, net operating income. This is the foundation of every commercial deal. Every other metric you'll ever run flows from this one number. We is simple. It's your total income from the property minus all operating expenses. Operating expenses include property taxes, insurance, maintenance, property management, utilities you pay, and vacancy allowance. What is not included? Your mortgage payment. We'll get to debt in a minute. So in our $1.4 million example, the seller says gross income is $120,000 a year. But what are the actual expenses? Let's say taxes are $14,000, insurance is $6,000, management is $9,600, maintenance reserves are $8,000, and we assume 5% vacancy. That's $6,000. Total expenses, $43,600. $120,000 minus $43,600 gives us an NOI of $76,400. That's our real starting point. Now that we have our NOI, the next number is the cap rate. Cap rate tells you the return you'd get on this property if you paid all cash, no mortgage. Lets you compare deals apples to apples, regardless of financing. The formula is dead simple. NOI divided by purchase price. In our case, $76,000, and for $100 divided by $1.4 million equals 5.46%. So is 5.46% good? That depends entirely on your market. In a hot coastal market like Sacramento, CA, and Reno, NV, 5 or 6% is normal. In a Midwest market, you might expect 7 up to 9%. The cap rate is only meaningful relative to what other deals in the same market and asset class are trading at. That's your benchmark. This is the one most investors actually care about day to day, cash on cash return. Unlike cap rate, this does factor in your mortgage payment. It tells you what percentage of the cash I actually invested am I getting back every year. Let's say you put 25% down on our $1.4 million deal. That's $350,000 down. Your loan is $1,000, $50,000, $1,050,000 at 6.5% over 25 years. That comes to roughly $89,000 a year in debt service. Now take NOI minus debt service. $76,000, and for $100 minus $89,000. That's negative $12,600. This deal doesn't cash flow at current pricing and rates. That's a problem, or a negotiation point. Cash on cash is annual cash flow divided by your total cash invested. We need either a lower price, better financing, or a way to increase income to make this work. Here's a number your lender cares about more than you do, and you need to know it before you ever walk into a bank. DSCR is debt service coverage ratio. It's NOI divided by your annual debt payments. Lenders want this to be at least 1.25. That means for every dollar of debt service, the property generates 1.25 of income, a cushion. In our deal, $76,000, and for $100 NOI divided by $89,000 debt service equals 0.86%. Bank will not loan on this deal as structured. Knowing this before you apply saves you weeks of wasted time. The last two metrics matter most for the long game. Equity multiple and IRR, or internal rate of return. These tell you how your investment grows over a whole period, typically 5 to 10 years for commercial. Equity multiple is simply total dollars returned divided by total dollars invested. If you put in $350,000 and get back $700,000 over 5 years, that's a 2 times equity multiple. IRR weights those returns by when you receive them. Dollar today is worth more than $1 in year 5. IRR is the annualized rate that accounts for that. Most institutional investors want a 12 to 15% IRR minimum on value-add deals. You don't need complex software to run a rough IRR. A simple Excel model with year-by-year cash flows and a projected sale value gets you there. So let's bring it all back to our $1.4 million deal. Here's where things stand. So, Noe, $76,000 and for $100. Cap rate, 5.46%, borderline for this market. The cash on cash, negative at current pricing. DSCR, 0.86, the bank won't lend as is. IRR, projection shows 8% at current ask, below targets. So is this a bad deal? Not necessarily. It's a deal that doesn't work at $1.4 million, but might work at $1.15 million. That's a very different conversation to have with a seller. This analysis just gave you the negotiating power. You walk in knowing exactly what price makes the deal viable, and you can defend every number. That's the difference between an investor and someone who just buys on gut feel. And here's something most people don't realize. Sellers often price commercial deals on income projections, not actual leases. Always go back to actual signed leases, actual expense receipts. The story the numbers tell you at face value is almost never the full story. So those are the 5 metrics that go into every commercial deal analysis I do. NOI, cap rate, cash on cash return, DSCR, and IRR. Master these 5 and you can look at any commercial listing and know within 20 minutes whether it's worth your time to dig deeper. If you're looking at a deal right now and want a second set of eyes on the numbers, tell me what you're looking at. I might turn it into the next video. I'm Dan with Coffee Real Estate. Subscribe if you want the unfiltered breakdown on how commercial deals actually work. I'll see you in the next one.